was a big earnings week, and we are going to cover 15 stocks that reported this prior week. Some companies I will dive into more than others, and I'm sharing information that is beyond just comparing to analyst expectations. I'm tracking their actual data, not estimates. So buckle up and let's get ready to talk stocks. Now, each company I will compare this quarter versus the prior quarter unless I state differently, as some companies don't break out numbers the same and I have to do year-over-year comparisons instead. So let's start with Coca-Cola. We will see here that they had an increase in earnings per share, their revenue declined some, their long-term debt though did go down, and the free cash flows went up. Now the cash flows, I did have to compare the 9 months this year versus 9 months end of last year. So consumer spending overall with Coca-Cola is still strong, and especially with smaller ticket purchase items like food and beverage products. The slight revenue slowdown from the last quarter to me doesn't show any weakness. Coca-Cola is a defensive company, a staple in many homes, and I think we do see some movement towards non-name brands, but not anything I see as worrisome with a company like Coca-Cola. Next up is Microsoft. They provided great earnings. You'll see their earnings per share went up, their revenue went up, their long-term debt went down, and their free cash flow went up. So all around great. So now we're going to look at revenue growth of products and services. I highlighted 2 products and services that I think are important future growth drivers, and anything in the double-digit range is healthy, and Azure and Xbox fit that bill. Of course, they just acquired Activision Blizzard, so I'm excited to see the growth of their gaming division. Xbox was 13% year-over-year revenue growth, so it more than doubled its acceleration of growth compared to last quarter's earnings results. Azure grew more than analysts expected and is up 29% year-over-year. That's amazing for a company that has the second most market share. That's impressive. Microsoft is proving it's one of the best companies in the world, and I am a happy shareholder and will continue to be one, as this earnings makes me more bullish as it increases this company's intrinsic value. A home run for Microsoft. Next up, we have Google. Their earnings per share went up, their revenue went up. They have some big revenue there, over $76 billion, that's massive. Their long-term debt though did go up, but the free cash flow went up as well. So their cloud grew 22% year over year versus Azure's 29%. So Microsoft's Azure, with the second biggest cloud market share, accelerated growth. Meanwhile, Google, with a far distant third place market share, decelerated growth from the prior quarter's 28% growth to now being 22%. Ad revenue came in strong and better than expectations. Overall, solid earnings, but Google Cloud needs to show some strength in upcoming quarters. Now on to 3M. We see the earnings per share did increase. The current revenue did go down. That long-term debt, it went down surprisingly, and the free cash flow went up. So better than expected, slight revenue slowdown, but it's still a company with many risks. We're talking about litigation, and one I want to sell out of. For me, not a dependable revenue-generating company. Next up is Visa with strong earnings. Their earnings per share went up, their revenue went up, their long-term debt went down, and their free cash flow went up. So consumer spending is still strong. Credit card usage is growing and will only grow into the future as more adoption occurs, and Visa is just an outstanding company, one I would like to own. Next up is Meta. Their earnings per share increased from last quarter, their revenue increased, some good increases there. The long-term debt did go up, but very slightly, and free cash flow is increasing. So they had great earnings. They're growing in users across all their platforms, but there is a huge cloud over their head as they're getting sued over young people's mental health, and this is something they'll have to fight for quite some time. Now, AI is Meta's answer to iOS's privacy change that allowed users not to be tracked, but Meta states that AI is helping boost its ad revenue. I said Meta would find a way around this, and they are. Also, the company said it expects Reality Labs' operating losses to increase meaningfully year over year due to their ongoing product development efforts in augmented reality and virtual reality, and they want to expand that ecosystem. So Mark Zuckerberg stepped back from the metaverse with his talk about it, shall we say, but I think deep down inside, he's in love with it, so this is something that'll be part of the company going forward. Now, Meta decreased its employee count by 24%. Mark Zuckerberg said it's the year of efficiency, and they're proving that, and the expense outlook was reduced, so all good on that side of things. Year to date, Meta is the second best performer in the S&P 500 behind NVIDIA. This company sank like a rock, but now has rocketed right back up. I held Meta and sold out due to what it's going through now, that's litigation, and the fact that social media is such a popularity contest, and I feel can change over time. We look at TikTok and its success, even though Meta tried to fight that. They will always be a target, and I don't want that risk with my stocks, but I will admit that Meta is not a bad investment Just everyone has different risk tolerances, and for me, there are other stocks I'd rather be in. Next up is ADP. Their earnings went up, their revenue went up, but their long-term debt went up ever so slightly, and their free cash flow declined. So it's a mixed bag once you look past the revenue and earnings per share. But overall, it's showing a strong jobs market still. I rate this company a solid investment. Now my favorite earnings of the week, they blew it out of the water, that's Amazon. Look at that increase in earnings per share. That's massive, as well as that revenue, almost $10 billion versus last quarter, an increase. Now the long-term debt is going down, which is phenomenal because this company, everyone complains about their expenses, so that's great. And the free cash flow, that is going up as well. In fact, if we look at this chart, we will see from about a year ago, their cash flow was negative 26 billion, where now it's positive 20 billion. What a change, what a turnaround, that's phenomenal. Again, let's look at all their different parts of their business. We'll see online stores is up 7%, physical stores is up 6%. Now, the next four to me are the most important. So third-party seller services is up a strong 20%, subscription services is up 14%, advertising services, look at that, 26%. I believe they have the best advertising business out there, so that's awesome. AWS is up 12%, and I'm happy about that. You may ask why when Google's up 22%, Azure is up 29%. Well, Amazon has the largest market share, and when you're in first, it is harder to grow. When you're big and have the most market share, double-digit growth like 12% is still very healthy. Now, I want them to beat expectations on some earnings, meet expectations. I will be fine with a few misses, but overall, they're dominant, and this to me is still a strong number. So Amazon is a beast of a company, and I'm very happy I'm an investor in Amazon. I think their convenience factor, AI growth, dependable recurring revenue, powerful ads business, and AWS dominance will keep this company growing and expanding beyond expectations for a long time to come. Next up is Hershey. Their earnings per share went up, their revenue went up, their long-term debt stayed the same, so I put that one in orange, and they did not provide their cash flow information, so if you're an investor, you want to look at that later when it does become available. Now, they had strong results showing consumer spending on small ticket items remains resilient. Hershey said it has not seen an impact from the weight loss meds at this point. Ozempic is one of the main ones, and it's too early to tell if it will have an impact in the future. I personally don't see these meds as a threat to the food and beverage industry. I did a video on this. If you're interested, I would go watch that. I think Hershey is a buy under $200, but I remain out of the stock due to competition and not having strong recurring revenue, that model that other companies have. So I do think Hershey is a good investment, but there are better that I'd rather focus on. And Hershey did, though, reaffirm their outlook and said they will launch exciting innovation to get 2024 off to a fast start. I'm excited to see what that's all about. Of course, with Halloween season, I expect strong Q4 results. Next up is Chipotle. They had a slight decline in their earnings per share, they had a slight decline in revenue, and their debt, oops, did I mess up? No, they have no long-term debt, but they do have something else I will talk about here in a second, and their free cash flow is going up, and that cash flow is comparing 9 months ended this year versus last year. So they don't have long-term debt, but they do have long-term operating lease liabilities that are increasing year over year, but that's a good sign as it's showing expansion of stores. They opened 62 new restaurants this quarter. 54 of those had what's called a Chipotlane, which is a digital app orders only pickup service, and that's their way of growing digital business. So I think that's smart and that's a positive. They're expecting to open 315 new stores in 2024. Comparable restaurant sales increased 5%. Chipotle is nowhere near the store count of big fast food companies like Taco Bell or McDonald's, but I can see them someday catching up, so there is massive opportunity for this stock. They offer something unique that is on the healthier side and with more of a homemade feel to it than a burrito from Taco Bell. They're very different products. Yes, these can be easily made from home, but it's still work to create when you can conveniently just pick it up at Chipotle, so I see a lot of potential with this company. Next up, we have UPS, not great earnings. Their earnings per share declined sharply, their revenue declined. The highlight was their long-term debt did go down, so that's good, but their free cash flow went down, and that cash flow is comparing 9 months ended this year versus last year. So they warned of economic headwinds. They expect lower revenue and thinner profit margins ahead. They say it's due to slowing global economy, but it also took a hit from a recent strike of its employees that did get resolved, but that caused customers to redirect their volumes to other services. UPS said they are seeing these volumes start to return. Many use UPS as an estimator of the health of our economy as they move about 6% of US GDP, I believe their earnings are more company specific than economy related, as we see other companies doing just fine like Amazon. UPS has tough competition, and it's not an investment I would jump into. We have another bad earnings, and that's Ford. Their earnings per share declined sharply, their revenue went down pretty good, their long-term debt is going up. That debt is massive, look at that. Also, their free cash flow did increase, but there's a reason why. So I included Ford to show why I do not invest in car companies. They have high capital expenditures, are dealing with a strike that will raise costs, they have to adhere to many safety and environmental regulations, they sell big ticket items that require a loan, and in a tough economy, anything that requires a loan will be pulled back on by the consumer hard. Ford is delaying $12 billion in investing in EVs. That's where that cash flow, I think, since they're holding back, it's staying a little positive. But EVs, the demand is not as strong as expected due to competition and price decrease pressures. And that's happening with most car companies out there that are trying to go towards the EV side of things. So it's kind of interesting. Most people I know are against EVs, so I think it will be an uphill battle to make it mass adoption, which is why I think we are seeing legislation almost forcing it. This is just not an industry I'm interested in, as financially there are too many risks and just risks in general. We are obviously seeing the proof of it with Ford. Next up is Intel. They had an EPS increase, a revenue increase, but their long-term debt is going up and their free cash flow went further into the negative. So looking past the earnings per share and revenue, there's still not a compelling story. Intel will have huge capex for a long time in order to compete with others and regain any type of meaningful dominance. Could this be a turnaround play? Sure. Would I be willing to risk that? No. So they are focusing on cost savings and had an upbeat forecast, but I'm not sure this will be sustainable. Only time will tell. Then we have VICI. Their earnings per share went down slightly, but their revenue went up. Their long-term debt went up slightly, but with REITs, that's okay. They use debt to acquire properties, so not a negative thing for me, and the free cash flow is growing. Most importantly, their adjusted funds from operation increased 16.4% year over year on a per share basis. They acquired 38 bowling entertainment centers. They continue to diversify and expand into other states. I just did a video on VICI, so if you want to hear all my bullish points, be sure to watch that video. VICI is a strong buy for me. Then we have ExxonMobil. They had good earnings. Their earnings per share went up from last quarter, their revenue went up, their long-term debt went down, and their free cash flow went up. I know many don't like oil and gas companies, but they are essential to our way of living, whether you like it or not. They will be around for a very long time and I think will be good investments. Of course, they come with risks, but I think our global dependency offers some safety with any challenges that come this industry's way. So even though they missed analyst expectations, just remember the price of oil and gas swings pretty wildly sometimes. We are also dealing with global conflict which affects demand, and this will be a forever factor with ExxonMobil and similar companies. But overall, ExxonMobil is a solid investment and I think will provide solid gains for investors well into the future. I don't think you realize just how many products use oil and gas. So there you have it, the 15 stocks from this big earnings week. But let's take a peek at my portfolio performance. I am up 2.25%. This is a huge decrease. I was up in the double-digit range early this year, and we see a lot of my companies turning into the red. So I'd like to see this as more of the stock market, the sentiment from investors, the emotional investing, whereas when we look at the earnings chart, we see much more green than red, and this is actual data. This is the company's actual numbers and results, and some of this red is company specific and not industry or economy related. So I see an economy that is still strong with some small challenges, but no signs of that huge recession yet. We shall see what next quarter brings. The fear index is high, but as we see, things are overall going well for these companies. People focus on doom and gloom, and that is creating a sell-off, but I just focus on the companies and their financials and fundamentals and ignore the fear and avoid emotional investing. So I will keep buying into my quality holdings regardless of the stock market swings, but will factor in where to focus my money based on valuations as well, but I'm staying invested regardless. So let me know what your thoughts are from this big earnings week, and if you see any weakness or signs of a recession that I might have missed. Are you staying invested? Are you selling? Or maybe you are new to investing. And so I appreciate all of you watching regardless of your expertise level or your experience with investing. Be sure to subscribe for someone who is honest, transparent, and treats this channel as an investing family where we are all here to help each other grow and become wealthy. That is all for today. See you soon on Mark Arnold's Finance.